What would you do if you could reduce your mortgage interest rate by 1%? Would you refinance or just stay where you are? Keep listening as we dive in. Welcome to the Money Meets Medicine podcast, where we talk all about the personal finance topics you wish you'd learn in medical school. I'm your host, Jimmy Turner, and here's your co-host who woke up at 6 a.m. recently to watch his Steelers play across the waters, Justin Harvey.
Dr. Turner, great to be here. Yesterday with my three boys, I had the really fun experience of doing bacon and pancakes. And then I'm on the West Coast, and the Steelers played in Dublin, which is cool. I realized I now have a new bucket list item of watching the Steelers play in Europe. And as much as I do resent the NFL's continued expansion into every holiday, every day of the week, it's becoming ubiquitous. I will say that I think the Europe thing is cool. And it's really fun having an early morning football game to participate in. And they won, which also helped.
So we're going to turn this into a sports podcast for a second because last night during the game, like our kids stayed up because they wanted to see who the halftime performer was going to be for the Super Bowl. And so we stayed up, and then they put the person on the screen, and I didn't know who they were. And
Who is it?
Kristen's like, I think I recognize who that is. And then they said it after the fact. It was Bad Bunny, who apparently like 100% of his songs are in Spanish. And so it was very obvious to me, kind of the same thing you just mentioned, where the NFL is trying to broaden its appeal clearly to other demographics and countries. And so they're playing in England now, or playing in Dublin and all sorts of stuff, and very, very different time zones. Have a Spanish-speaking person for the halftime show, which I don't know if that's the only time it's ever happened, but I imagine that must be a first, where every song is going to be in Spanish. Because to my knowledge, he doesn't have any English songs, but he is like number 12 on Spotify worldwide for downloads. He's wildly popular.
Yeah, Bad Bunny was one of those guys that's like, I realized that everybody else knew who that was for a long time before I finally got up to speed, but I'll excuse myself because I'm a man of a certain age with a certain musical taste, and the global hip hop genre or the global R&B or pop genre was not one of them. But that's great. I was kind of pulling for Taylor Swift, but I guess I'll have to wait one more year.
You're a Swiftie? Is that what you're saying?
I'm not a Swiftie, but I'm waiting for like her and Travis Kelce to be sharing the field at the same time.
Maybe that'll happen at some point. But yeah, so in other news outside of the NFL, as it turns out, because this is a personal finance podcast, the Fed ended up cutting interest rates in September by 25 bips. Cool kids call it, 1/4% of an interest point. I guess that's why they call it bips. It's harder to say that, isn't it?
Bips is short for basis points. BPS is what they.
Yeah, that's easier to say. I'm just going to stay with bips because bips is cool. But yeah, so they announced this, and it made me think about, hey, we haven't done a show in a while talking about interest rates and how that impacts financial decisions. We'll get there and talk about the Fed and how that may or may not actually impact personal interest rates that you see when you're making financial decisions. But either way, I thought it was a good time to bring up that topic. Before we dive in, don't forget the show is sponsored by Money Meets Medicine Disability Insurance. So if you're a physician, you need on-occupation disability insurance. It's the number one financial task for doctors. You can learn everything you want to know about investing or paying off debt. A lot of things we talk about on the show, but if you don't have an income, none of that matters. Please make sure you have own-occupation disability insurance. You can get a quote for that at moneymeetsmedicine.com/disability. We're happy to help you and be a source you can trust. We have the lowest denial rate in the industry. So happy and very proud of that. And you can get your help over at moneymeetsmedicine.com. So Justin, September 17th was the meeting. I forgot the date earlier when we were talking offline about this, but it was the 17th as I'm looking at my notes now, where they cut the target range for the federal funds rate by 25 basis points or bips to 4.00 to 4.25%. And the committee mentioned that going forward, their guidance is going to emphasize carefully assessing incoming data, the evolving outlook, and the balance of risks before making further moves. So basically, they look at the jobs market, they look at inflation, they look at a host of things and make a decision about whether to adjust the interest rates that come out of the Fed. And this has been interesting because there's been a lot of pressure for months and months for the Fed to drop rates. And this is the first time they've done this. And word on the street is many people think that there's actually probably going to be one or two more cuts in addition to this one. And so that rate in and of itself may or may not directly impact what you see in terms of your mortgage or a car or student loans. But theoretically, the Fed rate does impact treasuries and bond yields. And those treasuries and bond yields are often used to determine what interest rates are on some of those other products. And so I thought it was a good time because maybe 1, 2, 3, 4 months down the road, we see interest rates come down because of this, to have a conversation about interest rates. Because I bought a house when it was, I don't even remember what interest rate, but then I refinanced at 3%.
You lucky dog.
In 2020. And you bought a house on the other end of the spectrum when it was what?
7.25. So painful.
Yeah, 7.25. So there are going to be people out there listening that are in my situation that have a 3% mortgage or a 3% auto loan or what have you. And then there are going to be people that are in your shoes that have 7.25 mortgages or auto loans. So let's chat about moving interest rates and how you maybe talk to clients about that when that happens.
Yeah. So this is one of those things that the media loves to report on just to have something to say. But in my opinion, for a long-term investor, it's basically just noise and not signal. The Federal Open Market Committee, they have as a tool in the toolbox for sort of monetary management, setting the rate at which banks lend money overnight. The Fed lends to banks overnight. The overnight rate is what it's called. And so if they're adjusting the rate, that's the rate. And it is one of the benchmark rates from which treasury yields and ultimately mortgages and credit card, everything downstream is impacted by that. So when the Fed wants to create more permissive policy, more stimulus oriented policy, they reduce the rate, they make money cheaper. So it stimulates spending, stimulates investment. And ultimately, in the intermediate term, hopefully, as rates come down, ultimately I can refinance my mortgage. And some of my other clients who bought a house in the last year or two are going to do that too. The jobs reports, and I'm not one to like closely follow jobs data because it's another one of those things. It says a little something about economic health, but how the market responds and what it means for investors and over the long term, is there any impact? No, is my opinion of the short answer. But jobs reports have been revised down, and there is a sort of thesis unfolding right now that AI is essentially starting to gobble jobs up, and that some of the jobs reports that have come out in the last 12 to 18 months have been revised meaningfully downward and haven't been replaced. And at the same time, the stock market's going up, 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 up. So that is an interesting trend to observe economically. I don't think it's necessarily investable, but it's something that's happening out there. Donald Trump has also said in the past that one of his sort of domestic interests is to, or I think it was Trump directly, or maybe I'm remembering an analyst saying that this is something he should do, but basically like help everybody get a cheaper mortgage. And he has been pretty direct in his pressure on the FOMC, which historically there's been more, as we're seeing with a lot of the sort of silos of government, which previously had been a little bit more siloed. Those walls are dissolving, and whether you like that or not. And so he's just putting direct pressure on the Fed to say, lower the rates, lower the rates. And, you know, in the short term, it's like throwing newspaper on the fire. It burns faster, but ultimately it's hard to say what will happen in the long run. But I'm hoping in the intermediate run, mortgage rates will get nudged southward.
Yeah, I think that the goal oftentimes from, let's say, conservative leaders is that, hey, we cut these rates. That means that the stock market's going to go up. People are going to spend more money. People are going to be able to borrow things cheaper. And whether those things actually end up happening or not, I was actually curious as you were talking. So I looked it up as we're recording this basically over the last month, which is not exactly when that news broke. It looks like it's pretty flat. I mean, it's been 3%. The S&P 500 has been up 3% in the last month, but over the last 2 weeks, it looks like it's pretty much just stayed where it is. And so if it's going to have an immediate impact, it certainly hasn't had that yet. And not to say that it won't.
And that's, if I
Obviously,
could jump in here real quick, that's exactly why this is not investable and why it's noise and not signal. Because not only do you need to know what's going to happen, you need to like predict, okay, now they're going to lower rates. You also need to predict correctly, how are people going to respond to the news? And so you can actually get the event correct and the response wrong and misinvest. And this is true with like, you know, oh, Apple's earnings are coming out and like they're going to report sales of the new iPhone and they're going to be really strong. It's like, were they strong relative to last year? Were they strong relative to expectations? Are they going to be enough superior to previously communicated expectations that the market will like it and Apple will go up? Or if they report awesome sales versus expectations, but they give bad guidance for going forward, they might actually say, we sold a lot of stuff, but it doesn't look that good. And so the net effect of reporting a lot of sales is a decrease in stock value. So this is a perfect little example of why it's so difficult to make money by watching the news and investing in some kind of way.
I was mentioning this to you before the show, but I find this stuff fascinating, right? So for listeners, I've been reading a book called Discrimination and Disparities by Thomas Sowell, who's a professor, I think, on the West Coast. And just really interesting reading a statistician's views on how to interpret things. And he mentions jobs in the book, but one of the other things he mentions, which I find fascinating, and granted, I'm just learning about this, so I don't have an opinion on it, but he makes the case that it's like increasing minimum wage. So there's a lot of people who are like, yeah, that's a great thing, right? We got people, minimum wage workers, we're going to increase how much they're making, and that's going to help those people. And he basically makes the case that just because something makes sense intuitively, to your point, like just because you got the call right doesn't mean that how people respond is going to be the same because they're psychological beings. And in this book, he makes the case that actually when minimum wages are raised, what that often does is it produces more applications into a job pool. And then that employer is going to pick the most competitive, experienced applicants. And so when you raise minimum wage, what you end up doing is knocking out those like 16 to 20-year-old workers who don't have a lot of experience and don't have a CV and don't have a resume and don't have a lot of things to really hang their hat on in terms of, hey, why you should hire me other than I'm a hard worker. And so you actually end up displacing a bunch of the young workforce because of raising minimum wage, which then 5 years later, 10 years later, now you have an even less experienced group of 25 and 30-year-olds who needed that entry level job at the grocery store or at McDonald's to make a few bucks and put things together as they went to school or whatever their other professional goals might have been. And I just find it fascinating that what you think will happen when you do something like raising minimum wage, which seems like a great idea, we're going to help those people, actually may cause the exact opposite effect of what you intended. And that's why it's so important how this data is measured and how we thoughtfully think through it.
Yeah, and I don't know the last time you were in like a McDonald's or something, but the other effect that it has is it accelerates investment into technology that replaces those $22 an hour jobs. And, I've had these weird experiences where I walk in, I'm sure you've probably had this too, at different places, but it could be a McDonald's where there's the person at the cash register and there's also this big screen next to them. And it's like, well, I could talk to the person at the cash register, or I could go to the screen and do boop, boop, type on the menu on the big, then hit pay and then swipe my credit card. And then I go to that person at the register when I'm ready to get my food. But like the writing's kind of on the wall here. We can see the way the wind is blowing.
Yeah. So when I go to Chick-fil-A, I downloaded an app because there's two lines. One line is the, hey, go talk to a human line. And the other one is order ahead. And you just scan the QR code when you get there and the order pops in with no human involved. And then the food just magically comes out from another human to your truck. And that line was always shorter. And so I just downloaded the app and I would literally stop in the Chick-fil-A parking lot, put my order in, and then go into the line and scan the QR code. It would save me 5-10 minutes sitting in line. And that is obviously without a human, right? It's technology that's replaced. And that's one of the things I find fascinating, right? Is that the technology is supposed to be deflationary in terms of cost. But what it does do when that happens is it displaces workers that were working in that job. Now, a lot of people look at that as the sky is falling. Oh no, what do we do? And I would argue that, hey, let's look at the Ford assembly line, right? When they created the assembly line, they removed the ability to need as many workers manually turning screws, right? But those workers were then displaced to other jobs that the economy created. And so the hope would be that through AI, through advancing technologies, that other opportunities would happen. I do have a hard time imagining that those other opportunities are at minimum wage rates, which is where the rub is for me. And I'd argue the same thing is true for medicine, unless you're in a manual labor service of some kind, because that's much harder, in my opinion, to replace. And why I think procedural specialties are more protected than knowledge-based specialties, where your job is intake and output. I think that those jobs are much more at risk to AI and to technological advances than a surgeon who needs to do their hands and needs to do the surgery. I don't see a robot replacing a surgeon anytime in the next 20 years.
Probably depends on the procedure.
Yeah, probably. It probably does.
And even shouting back to our episode last week, talking about like student debt and capping how much can you pay for graduate degrees. Like, why would I pay $200,000 to get a master's of whatever when I can become an electrician and have a job that a robot can't take? Or it will be the last job that a robot takes. This is obviously a deep topic that I am not qualified to opine on beyond what I've already shared.
I think it's fun to talk about, even if we're shooting from the hip,
Yeah.
because I do think it's an important consideration. But drawing back to the original idea, right, that the original signal that happened, right, you can call that event correctly. You get an earnings report, or Apple's coming out with a new thing, or the Fed cuts rates, and you can know that that's going to happen, and actually not know, but guess that's going to happen based on the information you have. Get it right, and think that the market's going to do one thing, and it might do the exact opposite for reasons that you haven't considered.
Yep.
Hey, minimum wage helps those people out until it takes them out of the market because the employer is now paying more for the same work. So they're going to find the most qualified people, right? The Fed cut rates. So people should be able to borrow on the cheap. They should be able to spend more money. They should be able to accomplish these other financial goals. And that may or may not happen. But let's talk about in the future. Let's say that another couple rates come down the pipe. We do see mortgage rates start to come down. I know what my number is. I'm just kind of curious because, as a financial advisor, when you have somebody come to you like, hey, Justin, I saw the rates are X. I'm thinking about refinancing my house. What's kind of the breakpoint number for you in there? And I know it depends,
Yeah.
like everyone's situation is unique and different, but is there a number for
I
you?
want to calculate time to break even if somebody asks me that. So I want to see what the new payment is and how long is it going to take to sort of earn back the difference. Because I'm going to maybe pay $8,000 to close on a new mortgage or $5,000, and I'm going to have a reduction in my monthly payment, and how long to get that $8,000 back. That's a very crude way to approximate the answer, and it's imperfect. And you're also resetting the term on your mortgage, so it's not quite apples to apples. But in the short term, I think that's a reasonable way to look at it. It's also worth considering. Often banks, in order to keep your mortgage, will offer you like a sweetheart deal where maybe the rate isn't quite as good as the best rate out there you could find, but they'll like waive closing costs, or it'll be $1,000 to close. And so it shortens the break even time and it makes it easier to say yes. So as rates are sort of wavering right now and over the next 3 to 6 months, hopefully if they come down, something that I would encourage, especially mortgage holders, to do is to call your bank and say, hey, what are rates at right now? And do you have any special opportunity for me to refi my existing mortgage, which you already hold, at a lower closing cost? And that can be helpful.
Yeah, and another thing I should say before I say that comment, that number for me, when I start thinking about it and I start doing the math to figure out what the break even is usually a percentage point. If you tell me you can go from 7.25 to 6.25, I'm saying, go do the math and let's have that conversation. Let's see what that looks like. If it's a quarter of a percentage point or half a percentage point, I mean, is it possible that the math's going to be reasonable? Like maybe based on your situation, but when you get to one, I feel like that's when the math is like, hey, let's take a peek. Let's take a look. Another reason I want to mention this though, and get out in front of it, is with student loans, because what happens is if you have a situation where the federal rate that someone's borrowing at and the private rate that's being offered at banks becomes super competitive, it obviously encourages people more and more and more to privately refinance their student loans. And once you move from federal and you privately refinance with some company, SoFi, Laurel Roads, whoever it might be, you have permanently burned the bridge for public service loan forgiveness. You no longer have that as an option. And so the lower these rates go, the more I start seeing emails from physician finance bloggers and from companies and from faculty at my institution saying, hey, I had a great experience with company X, Y, and Z, so you should look into them to refinance your loans. And there's never that big, giant, bold red flashing letters that says, warning, if you refinance, you may be making a huge multi-six-figure mistake. And so as interest rates change, if that environment becomes a reality, if you have student loans, it's not to say that you shouldn't refinance, because that's the correct move for some people, but you absolutely shouldn't refinance until you are 1000% certain you are not doing public service loan forgiveness.
Totally agree. And I have observed an even more, I think it's like a higher frequency sort of need. PSLF is certainly an important thing to consider. And you should understand you're permanently saying no to PSLF when you refi. The thing that I think is a little bit even more common that people don't always consider is the need to adjust your cash flow and the need to have some additional disability protection. And the federal
Mm.
loans, you can basically pay zero at will. It's a little more complicated than that, but not much. And if something weird happened or you needed to hit pause, you can go into forbearance for years in most cases. And you can have an income driven repayment scheme where if your income goes down or you switch jobs or whatever, your payment can be recalculated down to something that's attached to the amount of money that you earn. And that can be really helpful. In addition, if you get hurt and you meet the Social Security threshold of full disability, which is basically a physician certifying, I don't think in the next 60 months you're going to be able to have a job, your loans go away. And you don't need to use your disability income check to pay off your loan to SoFi because your student loans have evaporated. So I think that's an important protection that I typically would say I want to see at least 50 to 75 basis points of improvement, maybe more. It doesn't cost you money to refi student loans the way it does to get a mortgage. So you can just sort of for free pay off your federal loans and now have a private loan. But you're leaving behind, yes, the PSLF benefit, but also the disability discharge and the income driven options, as well as the forbearance options. And those have real monetary value. I've had clients and I've known other people that have gotten that disability discharge where even like chronic illness, cancer, it doesn't need to be like my arm got chopped off, although it could be. But things that are like, oh, yeah, I know people who have had to downshift at back pain, stuff like that could position you for a disability claim that could result in student loan discharge. Those are often not considered and need to be factored in whenever you're considering a refi.
Yeah, the protections in the federal programs are important and I think are one of, if not the most overlooked thing when considering refinancing. They're like, oh, well, the interest rate's lower, and so I should do it. it's not just a math question. There are very real protections in the federal government programs that don't exist as well in the private programs. And to your point, I hadn't really thought about it before, although it makes so much sense given that I understand how these things are calculated. That let's say you're in the situation, right, where you decided to refinance in 2020 when interest rates were super low, and then you had some change in your circumstance, which led you to not be able to practice medicine, or you went part time, or something else came up and your income actually went down, but now the rates are 7%. Right? You're now in a situation where you'd want your monthly payment to be lower, but in order to do that, you'd have to refinance at a higher interest rate, which would cause you to basically pay more overall on your loan. If you'd been in the federal program when that change had happened, you just said, "Hey, I just want to recalculate my payment based on my lower income that I now have," and your monthly payment would have gone down. So I agree with you. I think it's really important to consider those benefits of being in a federal program before you refinance. In fact, I would argue it's predominantly not a math question. It is a math question only if these other really important things are also true.
Yep.
So, what are your thoughts on refinancing cars? We talked about homes, we talked about student loans. I've never refinanced a car. I've never had that situation, so I can't speak from experience on this one. Is that a thing?
Yeah, I think it is. I don't run into it a lot, to be honest. A lot of the car loans that I see are pretty competitive, and typically I'm encouraging clients to just
Pay the cash.
pay cash or just aggressively pay off any car debt that you have. There's always that like consideration of interest rate differential of like, here's what I think the market can give us long term. Here's what the car loan is. If they're kind of equal, then you want to pay off the car loan aggressively. If the car loan is like 2%, then just take as long as possible. So we're going to look at that. But car loan refinancing is out there. If you have a big car loan, yeah, you could probably do it. But I view that as a sort of a modest planning opportunity in most cases.
That's fair. That's fair. I thought it was an interesting time to bring up this interest rate discussion because of the Fed cutting rates. And by the time you listen in the future, maybe they've cut some more interest rates and you are experiencing a consideration of refinancing your house or a car or considering student loan refinancing. I think it's really important to think through all of the measures necessary before making that decision because it's not just a math conversation. As we head out, don't forget, show's episode sponsored by Money Meets Medicine Disability Insurance. You can get your own occupation disability insurance quote at moneymeetsmedicine.com/disability, where we walk you through a process created for physicians by physicians. And it is the lowest denial rate in the industry. So super proud of that and want you to share that with your friends. If you know friends that are looking for getting disability insurance, head them over to moneymeetsmedicine.com/disability and we will take fantastic care of them. Appreciate everybody being here and being a part of the community. As always, we'll see you next week. Cheers.